Now it's my pleasure to introduce our presenter today, Joanne Smith. Joanne is the president of Price to Profits Consulting, formerly the DuPont Corporate Head of Marketing and Pricing, and author of several books, including the Price Negotiation Playbook and her latest release, the Pricing in a Crisis Playbook. She focuses on helping B2B companies transform their pricing performance. At DuPont, she was instrumental in creating the pricing organization, which transformed DuPont from a weak to outstanding pricing performance. So with that, Joanne, welcome.
Well, thank you. Here we go. So we're going to talk about what I see as the 7 most common misconceptions of companies when they think about how to price in crises times or in tough markets. What are some of the things that they do that hurt their ability to get at profits? And so, a lot of what I'm talking about goes into my new book, Pricing in a Crisis Playbook, which came out in early April. So if you want deep details, that's the place to get it. So we're going to talk about it, obviously, with this recession pandemic in mind. But these are the same practices that might hold any time when you have a very tough market, maybe because supply demand is suddenly quite loose or energy prices are swinging. It applies in those times as well. So in these crisis times, we know that price pressure goes way up. These are tough times for our sales teams. And that pricing pressure comes from all sides, between the customers that are demanding price relief, from sales themselves that want to help their customers, probably from management who set profit objectives that are now unrealistic because they were set before the crisis happened. We got society and the pressures there to be a good citizen. And then we have some competitors, there's probably at least a couple that are maybe discounting too much, creating a more aggressive market. So it is a scary time. And unless our salespeople and our leaders really have the confidence and the skill in how to do our pricing in crisis time, we're going to have a difficult time. And there is never a more critical time to get your pricing really done well than in crisis time. So the 7 pitfalls I'm going to start with, or misconceptions, are shown here. I'm going to start with the one in the middle. And that's where I have that strategy versus execution. And if you think about which is more important for your profitability, for the success of your profits at the end of the day, whether it's in good times or crisis times, it's actually 50-50 on strategies and price setting side, and 50% on how well you execute. So we need to do both. And my first misconception there is those companies that basically focus on only one of these two. And I actually see the companies that are all about, it's only about our strategy, our price setting. We don't have to worry about sales. We just throw it at them. And we have the other side, companies that don't worry about their strategy and just say, well, it's tough times. Sales will handle it. That's their job to handle it. So they're only thinking about execution. You need to be good at both. So we're going to talk about 3 misconceptions on the strategy side and 3 on the execution side. The big ones I see on the strategy side are those companies who basically operate as if they believe they can't influence their market price, that they're not a key player to influencing market price. And so they do a lot of things unintentionally that cause the market price to go further down. We'll talk about that. We'll talk about those customers that tend to be so worried about being fair to their customers that it dominates their decisions in such a way that they're not being fair to themselves. So we'll talk about that. And then we'll talk about those strategies where companies try and protect their share, their volume at all costs. Clearly, we want to protect our volume, but there's a point where we need to think about that a little bit differently, and we'll talk to that. Now, on the execution side, what I see most often in terms of misconceptions is number 5 is where we know when there is a lot more supply than demand, we need to get back to customers pretty quickly in accepting deals. And as a result, some companies give their sales force even more freedom to work with price in crises so that they can move fast. And that can be a big mistake. Number 6, and I see this, I want to say 90% of the time, lots of people think they got experienced sales force, they're good at selling, therefore they must have good price negotiation skills, even for crisis times. Not the case. And the last is we underutilize market messaging, customer letters, etc., thinking they're really there for price increase times, and we're not effectively using them in crisis times. So let's start on the strategy side and around influencing the market price. So I just want to start with saying, what affects the market price? There's really 4 forces that are going on in good times and bad, and they are, at the very bottom, market dynamics. That certainly affects market price, and right now that's a pretty negative force for most of us. But how our customers behave affect market price, how our competitors behave affect, and our own behaviors have a critical effect. And all of these forces work together to either create more positive price pressure or very negative price pressure. So I think we all know that when our competitors get aggressive and do things, it affects what we have to do. So the opposite must also be true. Our behavior affects what our competitors do. So we're going to have to realize that what we do affects what's going on. And you are either in your company a positive force or a negative force. A negative force means you are contributing to a downward price spiral of price, potentially even a price war, where a positive force in good times might be that you're helping the price to go up. In more crises times, you might be a positive force in helping it to decline more slowly or less far. But there's no neutral position. You're either positive or you are a negative. And we're going to talk to those 4 kind of strategies on the right and how they affect a downward price spiral, from the worst at the top, meaning those companies that go for share gain, to those that don't have any strategy, they want to be a follower, to those that keep to their old strategy, the one that worked in good times, versus the best, obviously, is those that adjust their strategy, their price setting appropriately for today's crises conditions. So let's talk about this. Let's go to the gain share strategy that most of you probably recognize is not a good strategy, but you may have pressure from your leaders because the whole market demand's down and they're trying to figure out a way to get at profits, and they may be pushing you to try and gain share. But what happens here, we've already got negative market dynamics. They're working against us. They're red. Customers are suffering and they are strongly pushing for downward price pressure. They're red. If we jump on the bandwagon by giving this discount to the customer to try and gain share, then we're a red force, and we've just convinced customers that it makes sense to continue to push on price because it works. We give it up. And now competitors are hearing we're dropping price. They lose confidence. They start to drop price to defend their share. Now we got all forces against us. That's our biggest price war. So clearly not a good strategy. But here's the one I probably see more often, is the ones that don't have a strategy. They sit back and say, we're going to watch and see what the market does, as if you can sit on the sideline and not have an impact. Well, when that happens, we got negative market, we got the customers pushing hard, and it just takes 1 or 2 competitors to get scared and start to discount, that we get the competitors dropping, and you therefore will be forced to drop and catch up as well. So this sit back and wait means you are an enabler of causing this downward price spiral. So not a good strategy. Now let's go to this I'm not even going to change my strategy. I had in the normal times, I was raising price, I was doing great things, very effective. Let me just keep with that. So now you're a positive force in the fact that you're not contributing to a negative downturn. But if your previous strategy of raising price is now at a line which what would be fair and appropriate in your market, if you're now getting greedy, you're going for price that the dynamics don't really support, then you create trust issues and your ability to influence the customer and the competitor go way down. The customer sees you as greedy. They're going to continue their tough price pressure. They're going to jump and try and get competitors to come in. And competitors aren't going to follow you if they're looking at you going like, holy crap, the market doesn't support that. Why are they keeping price so high? I'm not going to do it. And you're going to get this discount. You will not influence near as well. So you're going to still see the decline. It's going to get away from you. And this can hurt your long-term relationships with your customer. So clearly, what do we want to do? We want to get the right strategy that is fair for you and the customer in these uncertain times. Because when we do it and we have it out of that fair base, we can then give the right arguments to our customer base to minimize, not all the way remove, but minimize their price pressure because we have valid reasons for our position. And the odds that the competitors follow us because we have valid reasons go way up if we're following all the good best practices in how to best influence a market. So that's where we're going to have our highest price, the least amount of decline, and only decline that is appropriate. So let me just say, as we think about it, many of you are saying, yeah, but we're too small. We don't influence the market. But let me just share with you some examples that hopefully will be teasers to make you think that perhaps you can. And I'm going to go to B2B in a minute. But right now, if we think about in the B2C side, we can probably all remember, if we're US based, back in 2008, the beginning of the Great Recession, the US airlines were struggling financially pretty severely. And there were, I can't remember, at least a half a dozen major airlines. An American airline at that time decided that they were going to start charging for checked bags as a way to bring in some financial stream to offset their struggling position. And as customers, we bitched and moaned. But in weeks, every major airline said, you know, that makes sense. We should do it. And they did it. And all of us accepted in very short order that paying for checked bags, it seemed reasonable to us, even if we didn't like it, and we changed the market. So this is just to say we do have influences. We can influence even in tough times. So let me just, oops, sorry, I jumped ahead a little too soon. Let me just show you a couple more B2B examples to kind of build up this story. And I'm showing you this chart of DuPont history of pricing, 15 years of pricing, quarter over quarter. So anything above the line is where we actually have good positive price. Anything below is on average where the company had lost price. And that section called large price gains, that's where I started running DuPont's pricing through that period of time. And you can see a statistical difference when we started to do really good pricing. And while we did many things, one of the biggest key things was for businesses and salespeople and leaders to recognize how their own behaviors, positively or negatively, affect the market price and how to get a less aggressive market so that we get our optimal price. So, and by the way, when we did this, customer loyalty went up. But what I want to just show you here is the 2009 Great Recession compared to much other milder recessions or issues in the past. So during that Great Recession, those same behaviors worked equally well. And in fact, we did much better in a much tougher recession than we had previously done by changing our behaviors. In fact, in that 2009 recessionary year, we brought in a positive $200 million of earnings for the company through price moves. Now, other years we brought in closer to $1 billion year after year. But during the recession, using these kinds of factors, we were able to bring in even positive, not every quarter, but net for the 4, a major increase. Now, let me go to 4 other businesses, client successes. And I picked these 4, they're plus or minus $1 billion, but all 4 of these businesses, and they spanned commodity to specialty, food to construction to chemicals, equipment. All 4 of them, what they had in common was very, very aggressive customers and competitors. They had low to no price increase success. They were having margin declines, so very tough markets. Most of them had good price resources, pricing teams. Some of them also had top of the line price management systems, but they couldn't get themselves out of these tough markets. And I worked with them less than a week to the most 3 weeks. So less than a week to 3 weeks. In that time, and with the actions we took, they brought in, respectively, for those price actions, $100 million in profit gain, $25 million. The last one, $32 million in profit gain. Number 3 wouldn't say, but they said it was their first very successful increase in 15 tries. Now, surely we worked on strategy and execution, but the big and fundamental difference here was for them to realize how they could, in fact, impact the market price positively. And in fact, they were unintentionally doing so many things that were hurting the market price, not even realizing it. So when they could get past that and realize they're a contributor, they could make that positive change. And by the way, I could have shown you example after example, including ones where my client had only a 5% market share and was able to change their behaviors in a way they affected the whole market. So you do not need to be the biggest. Now, if you're 1% of the market, yeah, you're going to have a tougher time changing the whole market. But even some of these things I talk about will still make sense. So in these crises time, you need a preparedness plan. Just like if there was a hurricane you knew was predicted to come into through your town, or some other natural disaster that was predicted, you would be prepared. You would not wait until the hurricane hit you to get prepared. You'd do it ahead. And in crises times in our business world, we got to get ahead. The more we are ahead on what we're going to do, the more likely we can influence the market. And if we wait too long, if competitors really start to drop significantly, it's going to be harder to turn that around. So we want to get ahead of it as quickly as possible. So let's just turn this a little bit further to the misconception number 2. And this really has to do with fairness. So if you know pricing and you know good practice and guidelines, the high level, the guiding principle in good best practices is to be perceived as fair and trustworthy, honest, open in the eyes of all players. You want your own sales force. You want your customers, influencers, competitors. When they look and interpret what you're doing, the more they see you as fair and trustworthy, the more they will be influenced by what you do, accept what you do, follow what you do when we have that happen. But here's the misconception that I sometimes see. I see clients that are so worried about fairness to the customer, they forget about fairness to themselves. In a sense, they're not looking at both sides. They're so worried about the customer, they actually turn to bailing out the customer. to accepting the whole margin squeeze themselves. They might have suppliers that are increasing cost to them or not dropping, and they're unwilling to pass it along to customers, and essentially they take the squeeze. And that's not good. And let me just give you a client example. I'm using a construction industry example, and I could give you several of these in the construction industry because I certainly see it happen a lot here. But in this case, customer base is thousands and thousands of contractors from the small to the large. And these contractors for years have claimed they barely get by. They can't pass along price increases. They can't do it. They're struggling. It's a dog-eat-dog world. And in this particular example, as in many, there's only a few suppliers of that particular product. And in this case, one of those large suppliers, like all the others, were not passing along price increases. In fact, we're allowing prices to decline because they were really getting sucked into the fact that the poor customer was struggling. What was the result? At the end of the day, these few suppliers gave up all their power to the thousands and thousands of contractors. And in this case, this supplier had to have their whole management team was wiped out and changed, and they had to have significant layoffs of people right across the board because they had gotten themselves so unhealthy. They're lucky they weren't sold off, actually, or shut down, but they had major hits of people and leaders because they felt too much on fairness to the customer, forgetting their own fairness. So we don't want to go into that situation. And again, more people do it, more companies do it than I would think would do it, but it happens. Now, so we need to think about what is fairness to us. For sure, your customers are going to tell you all the reasons why you should give them price relief. They're going to make sure you know their side of the story. You need to know your side of the story, and you need to know it well. So that means you're going to analyze internal data and external data, and you're going to do it at a granular level for every product, market segment, regional combination, because they're likely to be different pockets, to look for anywhere you might have favorable dynamics that might allow you to follow best practices for raising price. Most of us won't have too many of those, but you might have some pockets. Or you might have a mix of favorable dynamics that will allow you to follow best practices in holding your price and not letting it decline in some pockets of your business. And then you may have others where the unfavorable dynamics dominate. And then you need to follow the best practices for delaying or giving back the least amount appropriate for that still hits the fairness meter. So what are those kind of dynamics? So we certainly look for the more traditional. Is our market still tight? Is supply demand still tight? Do we have shared pain in our industry or rising cost in our industry that would allow us to hold or raise price, right? Even if our main ingredients are falling, do we have other costs that are rising so we don't have to give it all back? Has our margin been declining the last few years where we have a very fair argument to say we can't give it back until we get a more healthy margin first? Or if we look back at our past increases, many of us often, if we had rising costs and we passed them along effectively to customers, we might have taken months to do it. Well, if it took us months to put the price increase in, then we have a valid reason to say it should take us months to give that price increase back. The other sort of thing, we might even drive this to a customer level for sure, because some of your loudest screaming customers saying, you need to give me price increase, you've been putting price increases in, you need to take it back. The biggest screamers are often your large customers that, by the way, never took your past increases or only took a small percentage. So they shouldn't get it back if they never took it. So we're going to look at those kinds of dynamics to understand what your strategy should be at a granular level and what best practices you should do right? And all of this fairness needs to be set because ultimately it's how you're going to convince your salespeople why it makes sense because of this analysis. And they are going to use that same data to convince their customers on why it's fair and appropriate for whatever strategy you take. Now, having said this about fairness to yourselves, I do recognize that we are in such a severe crisis that if we think about this for a long term, we might, if you're, say, in a restaurant business or something, you might actually be looking at an enormous percentage, 30% or more of your customer base might not even live out this crisis. Well, if that's happening, we got to take on, we're going to have to give a little bit more than we would typically have to take. Now, quite honestly, if you're just losing a customer here or there, I would not change my pricing. I would keep to what is fair for you and allow them to fight to keep their boat afloat themselves. But if those boats are all gone down in mass and it's not just bailing out, they're definitely gone under. Now you may have to step in. And I would say we always want to, when we get into this situation, start with, where we can, non-price moves. Try and keep the integrity of our price up and work it first with non-price moves. What might they be? Extended payment terms, financial loan support, no penalty for returns. They may be, and I'd rather see you donate them some product and keep your price whole, then they can pay the rest, but do it with donating products, donating service, or have your charity be to the community, maybe not the customer base. And then, of course, if it gets so severe and you really do need to work that with your customers, then I would partner with your customers. Again, I'm talking a major section of your customers that would go under. And I would look to come up with some very few low-price temporary offers. So you might offer 1,000 products, but you might be like, these three are going to be very low priced. They're going to be no service. They're going to be stripped down. Maybe you even have to pick them up yourself, but they will get you through this crisis. Maybe not the one product you want, but it's close enough so that you're not disrupting your entire portfolio price. You're keeping it isolated and you're still helping your customer base survive through this. Now, obviously in my book, I go through a lot more of how to do these strategies and lots of techniques. We don't have time for that in a 45-minute webinar. So let's turn to the next default, and that is when we're in a strategy position, when we're trying to defend our share. Competitors are trying to take it. It's natural when your market size is already down to defend. And we want to do that. The more you, by the way, do some of those proactive behaviors I talk about, the less likely you're going to get sucked into this major defending. But if you do, keep in mind, and your management needs to keep in mind, and your salespeople need to, that price is 3 to 5 times more powerful than volume at affecting profits. That's on the upside and the downside. So we can give, like if we were to lose 5% share, that is the equivalent profit for most of us of 1 to 1.5% reduction in price. Okay, big difference. So we need to be sure our organization understands the impact of price volume trade-offs. And every now and then you may be smarter in a profit base to walk away from some business than to take the financial hit of defending and contributing to a downward price spiral. So here's an example. If you had products that are more commoditized, like a 20% contribution margin, all the way up to more specialty ones that might be in the 50%, that first line that it says 10% price drop to gain share, that's a proactive deal. If you decided I'm going to drop price to gain to gain share, if you're a commodity, you would literally need to double your volume just to maintain profit and get more than that to even make more money. No way that's happening. Even if you're a specialty product, you're going to have to gain something like 25% more profit gain if you had an offset of 10% price drop. Again, it's not going to happen. That price gain strategy, 99.5% of the time, is a losing strategy. Let's go to that second one that says don't drop 10%. This is a reactive. Somebody's trying to take your share. You're afraid you might lose your share. Should you drop? So if you're a commodity, before you would drop 10%, right, to protect that share, you could afford to lose 50% of your volume. And if you lost less, you would be better off financially. Even in specialty products, you could afford to lose 20% of your whole market before it made sense to drop 10%. So be sure that you do these sort of things, because often we drop price, we get the immediate loss that's worse, and we kick off the price war. So get that in the deal. And by the way, price volume, that makes sense strategically for your whole business as you think about your strategy, but it also applies deal by deal by deal. So let's turn to that execution side, the deal by deal. And this is the time where absolutely sales are screaming that they need more freedom. They need more room to negotiate price. They need to act faster. There's more competitors offering different things. They have to be able to respond. And this is where I say, no, no, no. We do not want to loosen our approval process in crisis time. Think about this. Just like the government is doing in the pandemic time, just like the government might do in wartime, we don't give more freedom to people to do anything they want. We go into command and control tighter till we work through those tough areas. And that's what's going to happen here. While your sales may think they need to drop price, we have to recognize that they're looking at everything deal by deal. And there are unintended consequences of deal by deal. We drop, we've just convinced that customer they should push us even harder, we might drop more. Our competitors hear about it. And by the way, the competitor just has to hear about 1 or 2 cases where you dropped, and they are going to immediately leap to the fact that, oh my gosh, they must be dropping everywhere, we better drop. And they start dropping and you hear about it. And the downward spiral happens. So we need to look at not just deal by deal, but every strategic move, because you could win one deal and undermine your entire strategy, causing that price war. So you got to put it in perspective and take the proper risk in light of your broader portfolio of products. All right. Let's go to the next execution area. And I'm going to ask you to self-assess right here, your own teams. This is where I've told you that a lot of businesses, even in good times, presume that their sales team, who's maybe very experienced, are also very strong price negotiators, right? And I'm going to ask you to rate yourself between 1 and 5. Your sales team, what you think they are in good times, and then ask yourself where you think they are in crisis time. 5 is awesome. So I consider a 5. Your sales team is confident that they negotiate their best price with each deal. They get a fair price for the value that you deliver in each deal. For each deal, they know when they have pricing power, when they don't, and if they have it, they use it. They increase price broadly with high success. And the toughest one, they consistently behave in ways that contribute to a higher market price. The opposite meaning, they don't do behaviors that unintentionally contribute to lower market price. So get in your head where you think your team is. I have surveyed thousands and thousands of salespeople, and when I ask salespeople, of which 80% are very, very experienced salespeople, only 5% self-rate in the 4 to 5 range. That means 95% in good conditions are 3, 2, or 1. You can imagine if I were to survey them during crisis time, that it would be even worse. They would be even less confident. So if the salespeople don't feel so confident about it, we shouldn't feel so confident that they are good at that. And it is so critical because they're the ones out there negotiating. They're either making decisions or they're bringing us back the information that helps us make a decision. And if they don't know how to do this, they're going to bring back skewed information, right? Which might convince us we have to drop when in fact we don't. So if your salespeople don't have confidence, they don't have courage, they don't have conviction when they go in or virtually go in to do their price negotiations, if they go in scared, unconfident versus really understanding that deal in their power position and where it is, or the buyers are going to sense this uncertainty, they are going to work them over, and that salesperson, no doubt, will over discount. So we need them confident. And that confidence comes in, 3 ways. First, they have to believe that the price is fair. So that strategy that you have set for these crisis time, they have to understand that rationale and believe in it. Or if you're very much into a value-based product, they need to understand the value in use and believe in it so that they can confidently sell it. They need to have price negotiation skills, not just sales skills, price negotiation skills. And then they have to believe that their leadership and the motivations are there for them. In other words, leaders are willing to accept some risk because there is always more risk when we go for our fair and appropriate price. And they need to be incented in a way that doesn't drive them to volume only. So when we have those 3 pieces, we do wonderful things. And I would just say from the skill side, that's an easy one to fix, probably the easiest, because a one-day course, the right kind of one-day course, in person better, but virtual works, can very quickly change the confidence of sales as well as marketing leader, pricing leaders, etc., to really understand how they impact the market, how to do it in ways that is not disruptive and positive, and how to make that deal by deal decision when they have power or not. And of course, I cover both of those in my books as well, if you're more into reading than courses. Let us go to that last misconception. These are the companies that say, well, yeah, sure, I do customer letters when I'm increasing, but not during these times, right? Not during these times. Well, that clearly is a mistake. And if we think about this, we know that whether it's our salespeople, our customers, our competitors, our influencers, whenever they're confused, there's a level of anxiety, there's so much uncertainty, there is mixed messages across the market, internally and externally. It creates trust factors. It creates more price pressure. We're pushed for price more. We're more willing to drop price when there is this lack of understanding and this much uncertainty. And so we actually have to up our game in communicating internally and externally. We need everybody, leaders through sales, on the same wavelength, the same positioning, the same argument, so that the more we're saying the same story, every one of us, the more we're going to be heard and influence that marketplace. So a couple of tips that work in good markets and bad markets. Whenever we are actually communicating the market message is weakest if we go to only verbal. Sure, we're going to do verbal, but if that is our only way, it has the least credibility in the eyes of your customer. When we do something written, better. And if a third party publishes it, like an article, an announcement, even better, even more credibility. From a fairness, the weakest is when something is signed by a salesperson. And the most fair is when it's signed by a higher level executive. Because if it's signed by a salesperson, it feels like it's not going to be fairly applied across the entire customer base. It feels like every customer or every salesperson gets to set their own position. But when an executive signs it, it feels like to the customer that all customers will be treated the same. And that is a good thing. We want them to feel fairness. And when we influence, it is always best to get as many venues out there, verbally, customer letters, an article in a journal, maybe an announcement. The more we have, the more that message gets out. And therefore, the more likely we are to influence all players to the extent that aligns best with our strategy. So let me give you an example that shows us this communication. This was a Polymer client. This business had been raising price for years, and part of it, a large part of it, was due to their rising raw material costs that they were passing along. Now, there were other reasons as well, but that was a key issue. And in the Great Recession of 2009, this entire market demand was so far reduced, greater than 20%. So volume was down for every supplier. And this client's raw materials were dropping. And the customers knew it. So by early 2009, customers were demanding price relief. They were saying, you've got to give me those savings you've got because you've been increasing me because of them for years. Give it back. And that sounds like a pretty fair argument, does it not? And I've said we want to do this out of fairness. So right away, a lot of the salespeople say, oh, well, you said we have to be fair. We have to give it back. Let's give it back. Well, let's wait just a second. Here is the kind of letter. This is not the exact. We've had, obviously, I'm disguising things. But rather than give back in early January, no, in early January, they put out a letter to customers that basically said, right, we will be dropping price. But by the way, it's going to be effective April 15th, not January 1. So it's coming, but it's next quarter, right? And they also said, and it doesn't actually say this here, a lot of the customers in this case were expecting about a 10% drop in price. But what they basically said, no, we're going to be going a discount next quarter about 5%. So they put out a number that was much less than the customer thought. And then they began to give reasons why this was occurring. So, and a lot of the rationale that was very clear was, in the past, they had absorbed a lot of increases for some time, and it took them months to get that price increase passed along. So if it took a month to get it in play, they were going to take the equal months to give it back. Only fair to both sides. And in their case, they also explained that a lot of the past increases, while a good deal was based on raw materials, there were other increases based on other factors around supply, demand, and value and other things. So they were going to pass back the appropriate part, right, that would be equitable on both sides. And they were very effective in calming the customer base down so that they recognized it was coming. They knew that was good. We set expectations on the amount, and we set it early enough. We diffused a lot of pressure with customers. And as it turned out, competitors, whether they heard it or felt it through other customers, also began to adopt a similar behavior. And we were able to delay and minimize the decline in that business. So kind of one of the last charts here is just to remind us what I said earlier. You need to get ahead of it with a crisis preparedness plan. This is the 5-step process that I developed in DuPont and have refined with my customers over time, and it's the center of my my recent book. But you need to really do 1 and 2, which is all that monitoring, predicting, analyzing, internal and external views to set very granular strategy and tactics that align with best practices, build your communication plan to reinforce it in the market, tighten approvals. And what I haven't talked about is you do need a little crisis team and process, because we don't know how long this crisis is going to last. Is it going to get worse? Is it going to come better? So whatever strategy you set, you're probably not going to nail it exactly right. You're going to have to modify it. And for sure, if it gets even worse, or certainly as we come into a recovery, you're going to need to modify it. And you want to do that as quickly and proactively as possible. So that's why that crisis team is in there monitoring all the time. Now, one just last page, and this is a little bit separate from the talk that I've given, but given the audience and the fact that you're on a leverage point, which probably means you understand value and use pricing and you appreciate the high value of that, I just want you to know that I am doing a virtual workshop. It's over several days, but it's an applied project where you can have a small team attend with a project and you want them to do the value and use pricing using best practice. It's a teach learn combination. If that interests you, feel free to get back to me and I will give you some more detail. So again, with that, pricing in a crisis is the playbook that I had published early April that goes into more detail across all of what I spoke about. And Nick, I'm going to turn it back to you.
Great. Thank you, Joanne, for sharing your really timely insights on this. And if you're interested in learning more about the workshop, you can respond, just reply in the comments in the post-webinar survey, and we'll have Joanne reach out to you with details. As usual, we've had a few questions come in during the webinar, and there's still plenty of time to enter your question into the panel on your screen. While you're ending, a reminder to take the survey at the end of the webinar, and you'll be entered to actually win a copy of the Pricing in a Crisis Playbook. Now, to give everyone a few minutes to enter your questions, a few quick words on leverage point. Joanne just walked through the ways that B2B commercial teams need to adapt in challenging economic environments like the one we face today. A key part of the communication plan she discussed involved conveying your unique value to customers. And why is that so important? Well, according to Forrester Research, the first vendor to succeed in communicating a vision of value to executives wins the business 74% of the time. This is true in normal times, but especially true during times of economic uncertainty. With a strong value proposition, your customer engagement will increase, and so will your odds of remaining resilient during challenging times. So that's where Leverage Point comes in. We offer a SaaS solution that aligns entire business teams, product, pricing, marketing, sales enablement, and sales around creating, capturing, and communicating value. So how does it work? Well, first, product marketing and pricing team members build custom branded value propositions that help sales tell the story. Then they publish that value proposition into a cloud-based library that is accessible by every rep at your organization to customize in real time for each customer's and prospect's needs. Finally, beginning with the first sales call or first customer call, sales teams can modify the customer's baseline data in real time in order to create a unique business case to buy that the prospect can leverage internally to drive the deal or the renewal forward. Early on in the sales process, value propositions are useful as flexible case studies and call prep, and in building sales confidence and qualifying opportunities, and just with engaging customer executives. Towards the middle of the sales process, value propositions provide customer value analyses as an important consultative selling tool to address pre-sales challenges. When you get to the purchase stage or the renewal stage, the value proposition becomes a shared business case to buy that's collaboratively agreed upon between sales executives and the customer sponsors. That serves as the buyer's internal financial justification to purchase and the sales team's asset when you get to the price negotiation stage. Now, who wins? Well, value propositions and leverage point can be linked directly to an opportunity in Salesforce. It can also be downloaded as a PDF or a PowerPoint at any time for a personalized leave behind. On average, our clients achieve a 5 to 15% higher close rate at 5 to 25% higher prices when using leverage point value propositions. Now, if you found any of this interesting, let us know in the post-webinar survey, and we can schedule a custom demo for you and your team. So now it's time for the Q&A. So the first question I'm seeing come across the line, Joanne, I think this is a good one. So of the 7 pitfalls, which ones do you most commonly see businesses struggle with? And also, which ones have you seen lead to the biggest negative impact?
Okay, so tough question here, Nick, because they're all important, but I would think there's really kind of 2 that go right to my mind. First is, if we really think that we don't impact our market, we're just playing in our own little bubble, then all things fall apart. Even in good times, you don't go up and you go down farther. And maybe on the non-strategy side or the sales side, we so often think our salespeople are stronger at price negotiations, and they are, in general, not. And so when you're messing up deal by deal, you're affecting that deal and you're affecting the total market. So I would say both of those are probably the 2 that jump to my mind more than anything.
Great. So the next one I'm seeing involves the crisis team that you were talking about earlier in that final slide. So which stakeholders in a B2B business should be involved in that crisis team?
So it can be any small team, but in general, normally you have somebody who's maybe a pricing manager or somebody who can really spend the time. And the key is to have the time and the data to be monitoring all the time to see if anything is changing, if we're really being successful, if we're, losing volume or whatnot to adjust. But because we know pricing is actually should stem and support a business and marketing strategy, your steering team needs to be probably your little, whatever your business team is, that would be a good one. So that, because they're the ones that have to accept a certain risk and know whether we're going more niche or penetration. So they should be updated, whether it's weekly or monthly, to make sure they are on board with the strategy and how it's coming out.
Great. This one is about salespeople. So we talked about sales negotiation skills and some learning gaps there. What specific and learnable skills with regards to negotiation do you see your average sales person struggle with the most?
All right. So in general, and I say, a one-day course, we can really change them around. There are a number of things that when we put them together, the light bulb goes off with sales. And if you try and just say, well, it's only this one thing or it's only that thing, they don't really understand the complete picture where the light bulbs just start boom, 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 boom. So there is a piece where they need to understand how their behaviors affect the whole market, so they recognize they can't operate in a vacuum. And then there is the piece that says, deal by deal, how do I know in any given deal whether I have the pricing power and should hold firm, or whether I really better discount and or walk away? And I tend to use an 11 question framework that brings in a lot of skill, but comes down to an easy framework to allow them to make those tough decisions in a way that optimizes the deal, and they do it in context of understanding the whole market.
Fantastic. So we've got one on value pricing and value selling. So how does the utilization of value-based pricing and selling impact pricing conversations, specifically during uncertain times?
All right, so pretty critical. I don't care when you're selling. If you can tell your value story in a better, clearer way, as Nick, you will know, you're going to make higher price and more sales. Now, in crisis time, we got people that are even more price pressure oriented, even less likely to want to hear your value story because they are in crises. And they're more likely to switch to a lower cost offering. So now it becomes very important you get that value story so they know what they would be walking away from. Now, also when I think of that value story, some customers' needs actually change. If they are so much almost going out of business, almost going bankrupt, whatever you thought their needs were 6 months ago, those needs have changed. And a good value conversation allows that dialogue to see what needs are being turned on and off. And it might allow you to adjust your offering if, in fact, they are truly just can't afford, they are in survival mode. It may be that you need to adjust and that the offering and the price aligned with value. But that's the beauty of a value conversation. It'll allow you to get there in a win-win way and get you away from just talking price.
Great. And I think we have time for one final question. So this is about services, actually. So how can services be leveraged alongside product offerings during times of uncertainty to either maintain share or price?
All right. So if we think about services, and many of us have technical service or application development or other kinds of services we do, and we do them in normal times as well. So it kind of go back to our last conversation. That should be in your value pricing. If you're offering those services, you should have that in your value story, why it's important, and help you to maintain share because you add this additional value and you deserve a price for it. But like I said last time, that conversation for those customers that can no longer afford it, it allows you a great dialogue to say, well, can you not, if you can't afford these services, if you're willing to give up this yield improvement or this whatever my service does for you, then in fact, I can give you a lower price and maintain my share. So it allows you those services to distinguish yourselves for those that are still willing to understand and pay for value, right? And there will be some that during crisis times go right to the value supplier they know has their back because they know with this uncertainty, they want somebody that has their back, and that's going to be great. There will be some that are hunkering down thinking they're going out of business and they're going to go low price, and your value story will allow you to strip it out and work with both sides.
Fantastic. And I think that's a great place to leave it for today. So before you go, a reminder to pre-register for next month's webinar during the exit survey. We're going to be joined by Peyton Marshall, and he'll be exploring the ways that B2B customer success teams can keep and grow their existing accounts by focusing on communicating customer value. This is another timely subject in today's economic environment, so make sure you pre-register. And that's it from us today. I want to give a special thanks to Joanne for her timely and insightful presentation. And a special thank you from those of us from Leverage Point. Have a wonderful rest of your week and take care. Bye-bye.